Good morning and welcome back to another pipeline trading video today. I had a lot of requests following the videos I put out yesterday on the overall markets, specifically what I'm expecting from the S&P and the NASDAQ. So I want to walk you through exactly what I'm seeing. Keep this simple, and most importantly, keep you level-headed. Right now, we're looking at the QQQ, which is the ETF that tracks the NASDAQ. And what stands out immediately is this. We are about to breach the 200-day moving average again. We broke above it recently, but now we're opening back below it, and that matters. You can also see this trend line I've had drawn, and it's been acting as support, and now we're sitting right on it again. At the same time, these levels you're seeing here are Fibonacci retracements pulled from the April low during the tariff move up to the recent high. Now here's where it gets important. This blue zone, right? Here is an order block, and typically, price seeks liquidity. So even if we are going higher long-term, and I do believe we will eventually make higher highs before that happens, price is very likely to come back and take out liquidity in this zone. And what makes this even more significant is that it lines up with the 0.382 Fibonacci level, right around 547. So if we break below this level and then come back up and reject it as resistance, I would expect price to move down into that 547 area on the QQQ. That would also fill this gap from the move up in April. Now, these green zones you're seeing are fair value gaps. Not all of them get filled, but they represent areas where price moved inefficiently, so naturally, the market tends to revisit them over time. If we start getting negative news tied to the current geopolitical environment, I think we don't just tap the 0.382, we likely move deeper into the 0.5 or even the 0.618 Fibonacci levels. And that 0.618 level sits around 491. That's a level a lot of traders will be watching closely for potential long positions. Now if we shift over to the SPY, which tracks the S&P 500, it's the exact same setup. We're testing a key level that was previously acting as support. If that breaks and turns into resistance, the next logical move is a drop into liquidity below. I'd expect a move towards 614 initially. If that doesn't hold, then we're looking at a deeper correction down into the 0.5 or 0.618 levels again, filling more of those inefficiencies. And just to put that into perspective, from the highs, a move to the 0.382 is about an 11 to 12% drop. The 0.5 brings you closer to a 15% correction, and the 0.618 is pushing close to a 20% correction. Now this isn't unusual historically. Over the last 100 years, markets have seen frequent corrections. On average, you get a 10% correction every couple of years. And roughly every 6 years, you'll see something closer to a 25% drawdown. That's what we consider a true bear market. But here's the key distinction. When you see a sharp, aggressive drop in a very short period of time, that's capitulation. And capitulation often leads to a V-shaped recovery. It's not a prolonged bear market, so context matters. Now shifting over to crypto. If you look at Ethereum, nothing has changed. We're still below the 50-day moving average, and this is on the daily time frame. That level is acting as resistance, and we're still inside a bear flag. Yes, you can absolutely see short-term upside levels like 2,281 are still in play. And depending on how long price consolidates, you could even see a push toward 2,400, but the bigger picture hasn't changed. The macro still leans bearish unless we break above key levels and hold them. And to be clear, if we break above the 50-day moving average on the daily time frame and hold it as support, that changes things. That's when you start looking for continuation higher. It's potentially toward the 200-day or key Fibonacci levels, but we're not there yet. Now looking at Bitcoin, it's even clearer. Price has been stuck in this range, and if you go back to the 3-day time frame, which I've talked about before, had a death cross, and a lot of people misunderstand that signal. A death cross doesn't mean the market crashes immediately. What it means is that the conditions are set for potential downside. And what usually happens is you get a bounce. People get bullish. They think the breakout is real. and then the market rolls over. That's the trap. Could Bitcoin still push higher? Sure, it could move up toward the 50-day. Even test the 200-day moving average around the high 80,000. But based on the current macro environment, the structure of the charts, and overall sentiment, I don't see a sustained move higher right now. Any upside, in my opinion, would likely be short-lived. And a big part of that comes down to what's happening globally. You've got geopolitical tension, uncertainty around policy, inflation concerns, and all of that feeds into market volatility. Even if we get positive headlines, those moves can fade quickly, and that's why I keep saying ignore the noise. No one is going to come out and tell you exactly what's going to happen. The market moves based on positioning, liquidity, and probabilities, not headlines at the end of the day. Both sides politically are going to do what they need to do. There are bigger forces at play behind the scenes, and as traders, our job isn't to predict narratives, it's to react to price. So focus on the charts. Watch the levels. Let the market show you its hand, so stay patient. Let the market confirm direction before making any decisions. Don't chase narratives. Don't follow the herd. And most importantly, don't let emotion dictate your trades. So like I always say, if you found this video helpful and you want more breakdowns like this for me to just, when I see things and I hear things, to call it out just to keep you level-headed, shut out the noise completely, and focus on the charts, subscribe, hit the bell icon, and stay connected. As always, stay disciplined. Trade with intention, and God bless you all. Thanks for watching.